Ever wonder how the real Wolf of Wall Street, Jordan Belfort, made so much money? It wasn't just about selling stocks. It was about manipulating the entire market. Let's break down exactly how his infamous scam worked and how you can spot similar red flags today. It all starts with something called a penny stock. These are super cheap stocks, often trading for less than $5 a share from small, unknown companies. Because they're so cheap and the companies aren't well known, they're incredibly risky and not usually traded on major exchanges like the New York Stock Exchange. This is where the scam begins. Belfort and his firm, Stratton Oakmont, would buy up a massive amount of a particular penny stock. Imagine they secretly buy millions of shares in a tiny tech company for just 10 cents a share. They now control a huge portion of that company's stock. But at this point, nobody else knows or cares about this stock, so its value is still low. Next comes the pump. This is where the magic, or rather the manipulation, happens. Belfort trained his army of brokers to cold call thousands of potential investors. They weren't just regular salespeople. They were masters of persuasion, using aggressive high-pressure tactics and carefully crafted scripts. They'd pitch this worthless penny stock as the next big thing. They'd lie, saying the company was about to launch a revolutionary product or sign a huge deal. They'd create a sense of extreme urgency, telling investors, this stock is going to the moon, and you have to get in right now before it's too late. They'd promise guaranteed massive returns, which is a huge red flag in any legitimate investment. The goal was to create a buying frenzy. As more and more unsuspecting investors bought into the hype and purchased the stock, the demand would artificially skyrocket. Basic economics tells us that when demand goes up, so does the price. So that stock they bought for 10 cents a share might climb to 50 cents, $1, or even $5 a share. On paper, everyone who bought in, including the early investors, is making a ton of money. But here's the final, crucial step: the dump. While Belfort and his brokers were convincing everyone else to buy, they were secretly getting ready to sell. Once the stock price reached its peak, inflated by all that fake hype and investor money, they would dump all of their shares at once. They'd sell their millions of shares at the high price, making an astronomical profit. For example, selling a stock for $5 that they originally bought for 10 cents is a massive return. But what happens when millions of shares are suddenly sold? The supply overwhelms the demand and the stock price crashes. The stock that was worth $5 a share plummets back down to pennies, or even becomes completely worthless in a matter of minutes. All the regular investors who bought into the dream are left holding the bag, their life savings completely wiped out. Meanwhile, Belfort and his crew have already walked away with millions in cash. They rinse and repeat this process with another worthless penny stock, leaving a trail of financial devastation behind them. This pump and dump scheme is a classic form of securities fraud. It preys on people's desire to get rich quick and their fear of missing out. The key takeaways? Be wary of anyone promising guaranteed high returns. Always do your own research on a company before investing, especially if it's a small, unknown entity. And never let yourself be pressured into making a quick financial decision. Legitimate opportunities don't require you to decide in 5 minutes. The story is a wild ride, but the lesson is simple. If it sounds too good to be true, it almost certainly is. Thanks for watching, and if you found this breakdown helpful, be sure to like and subscribe for more deep dives into the world of finance. Stay safe out there.